Okay, so good evening everybody and welcome to First Intuition's Management Accounting Decisions and Controls revision session. This evening we're going to be covering task 7 and 8 of the exam. So it is the final session of this year. So hopefully you've been with me for the past couple of weeks, so you've seen a range of examples from task 1 right through to the end of the exam, which will be this evening, which is task 8. Okay, so what we're going to do then is we're going to go straight to our notes. Okay, so you should have all received the notes for this already. And we're going to start off on page 25 where it looks at task 7. Okay, so I'm just drawing out the core information from the briefing of this task. So as it says at the top there, this task you will ask to produce an analysis of the performance indicators, and you're going to have to calculate it in the form. You're going to have to do calculations, and then you're going to have to do some explanations in a written report. So there's more writing in this one. So we've seen a writing task already in task 5. So there's further writing to do in task 7 of the exam. So it's worth around about 18 marks. So you should give yourselves around 25 minutes to try and complete this question. So as I've said, the earlier tasks, if you can get them under the guided time, you've got more time to then focus on your answers when it comes to the written elements of it. Okay, so in this exam, what you need to be doing is you need to have a good understanding of those performance indicators. So we covered that last week in task 6. Okay, so have a good understanding of what those are. As I mentioned, get flashcards if you need to, in terms of writing and remembering those flashcards. Okay, so you're going to have an understanding of those performance indicators and the decision-making tools that businesses might use when we come to making decisions about a product. Okay, so you need to be able to also create a coherent explanation, and what we mean by that is a logical explanation. Okay, you're going to have to look and understand what they mean and be able to have a view and understanding of the effect of what's going on once you've calculated those key indicators, just so we can have a look at the business as a whole. So things that will come up which are not new to you, shouldn't be new to you, is being able to do the analysis. Okay, so this is where you're going to look at the differences between the performance of maybe of an organisation, comparing one year to the next, or comparing one product to another product, or it might be where you are comparing different organisations against each other and their products as well. Okay, so just in terms of the analysis, if we're talking about gross profit, what it's like from one year to the next, or what it's like if we produce one product which has other costs incurred against another product. So there's a couple of things there about the analysis. Again, looking through break even. Okay, so remembering break even is the total contribution that we need to earn, okay, which must match our fixed costs, and within that sometimes we need to include profit as well. Okay, so again, not going to go through this in and out because this is something that you should know already at this stage of your studies through attending tuition at your training provider. So this task briefing here just outlines things that might crop up in the exam. You might have to look at limiting factors where you've got some scarce resources. You might not have enough labour time, you might not have enough material to make that product. So you need to be able to look at the analysis there of what you have and what you haven't got. Okay, so what we're going to do then is we're going to jump straight into this task 7. Okay, and we'll work through it step by step, going through all the calculations to try and make it easy. So yes, it is, it's the mock one. It's what you should have been sent through the AAT revision centre. Okay, no worries. So task 7. It says here then, a business operates 2 products, gamma and beta. So again, key point that was brought out from one of the students last week was you get points for actually stating the names of the products in your report, because it makes the examiner aware that you've actually read the question in detail. So make note of what those products are called, okay? And it's told us there about the information of last month, okay? So we've got sales volume for each of the products, we've got the prices, the variable cost, and the fixed overhead costs. But what the managed finance manager wants to do in this question is calculate the contribution per unit, the break-even point, and the margin of safety for each of the departments, okay? So, and then what we then have to do is draft a report and analyse our findings, okay? So the first thing that we're going to look at is gamma. And actually, you can do this combined. You can do it as you're going along, so you're not looking at one company then having to redo it as another one. So I'm just going to do some workings to the side here. Again, you have the information there in front of you. So all we're going to do is going to set up two columns. Okay, the first one being gamma, and obviously the second being beta. Okay, so if you've got a spare piece of paper just to the side, that will then help you to obviously get your calculations going. So the first thing that we need to do is work out the contribution per unit. And as we're aware, the contribution per unit is just the selling price minus the variable costs. So with gamma, we've got a sale price of £8 according to the table. So if you can look at that here, we can clearly see there is a selling price there of £8. And beta is exactly the same. It has the same selling price. Okay, we then need to take away the variable costs for each of these products. Okay, so the variable cost for gamma is £6.50 and £2.80 for beta. So when we just simply deduct those away from each other, you have a contribution per unit of £1.50 for gamma and £5.20 for beta. Okay, so well done for those who have put that answer in the box. So we can simply complete that first box for each of the products. Okay, so you've got £1.50 here and £5.20 there. The next thing that we need to look at is the break even per unit. Okay, so what we have to do is we got to work out the break even, okay, per unit. That's simply taking the total fixed cost and dividing that by the contribution per unit that you've just calculated. Okay, so taking the fixed cost for gamma from the table, as you can see at the bottom, is 93,000, and for beta it's 254,800. Okay, so just for my workings at the side here, 93,000. Divide that by £1.50, and the 254,800, divide that by 520. Okay, so that's going to give you the break even in units. Okay, so we've got 62,000 units to produce to break even, and then for beta, you've got 49,000 units to break even. Okay, so again, we're just going to simply put those figures into the table here. So 62,000 and 49,000. Okay, well done. So in terms of the margin of safety then, when we actually calculate the margin of safety, what that is just the difference between the volume that you have produced and the break even, okay? So it's the sales volume minus your break even in units. Now, because the question is actually asking us to show it as a percentage, we need to perform two calculations for this method. So first of all, we will find out what the margin of safety is in units. Okay, so from the table of data up at the top there, we've got the sales volume of 70,000 and 50,000. Okay, so you're going to take your 70,000 minus the break-even units of 62, which gives you a margin of safety as 8,000 units. Doing the same for beta, 50,000 is your volume, your break-even in units was 49,000, giving you a margin of safety in units as 1,000. Okay. Once you've been able to work out that, you then need to turn it into a percentage. Okay, so the way you would turn it into the percentage is you would take the margin of safety units, okay, and you just simply divide that by the sales volume. Okay, and then you multiply that figure by 100%. So we've got the 8,000 units for gamma, you've got the 1,000 units for beta. The volume we've already established was 70,000 and 50,000. So once you do that simple division, okay, multiply them by 100, and we can see that we have got 11.4%. and 2%. So do it to around about one decimal place, unless you are told otherwise in the exam. Okay, so we just simply got to put these figures into the bottom. So 11.4% and 2%. Okay, so well done there. So that's the calculation side of things done. So we've done the first part of the task. What we now need to do is draft a report in which you provide an analysis of these figures that we've been given and what we've just calculated. Okay, so luckily enough, in this exam, it does give you the headers that they do want you to talk about. Now, I will send you through, as I did last week, a full copy of the textbook answer, but just let's have a quick think about these questions. So it says, first of all, provide an evaluation of the differences in contribution between the two products. Okay, so the first thing that you're going to do is state what the contribution is between the two products. Okay, so again, I'm just going to write this in brief, but I will send you it through in full, full detail. So in here, the contribution per unit, okay, for beta is much higher. Okay, is much higher at £5.20 than gamma, which is at £1.50. So you're clearly showing the examiner that you have calculated the contribution per unit and you've identified that beta has a higher contribution per unit. Now, what you need to then state is you need to kind of state why has that happened. Okay, so if we have a look within the data, in the table of data, if we can see that both have a selling price of £8, it's quite obvious that from the data of information, the reason why beta is showing a higher contribution is because gamma has a higher variable cost. So well done there for Pat in the chat there. You've put beta has a lower variable cost. So whichever way around you want to say it, it is absolutely fine. So you could put the main reason is because the variable cost for gamma is higher, or the main reason is because the variable cost for beta is lower. So that is the third, that is what how you would explain why. So just a little bit of tip in there. So why has that happened? Okay. As I've said, I will send you through the textbook answers. Okay. Then what we need to do is we need to have a look at if we was to make the product initially from the contribution, what product would give us the better, the better results, the higher profit. It's going to cover the fixed cost. It might cover the profit that we're trying to achieve. Okay, so when we go back to our figures here, because beta is actually given as a higher contribution, it might actually look from the first look that beta is the better product. The beta looks better. So on initial reading, it might look better for beta because it has that higher contribution. Okay. But what we need to take into consideration okay, is the sales volume. So although the sales volume of beta doesn't match gamma, it does give us that higher contribution, but the sales volumes don't actually match. So we need to take those the volumes into consideration. Okay, so just expanding a little bit further on that. So what we would then add in a little bit there about, we would say something on the lines that beta, okay, not only makes, so I'm just writing these notes down, not only makes the higher contribution per unit, okay, but also is expecting a high sales volume than gamma. Oh, it's actually not. Sorry, that's the other way around. Sorry, which would be low. So beta's not only making the highest contribution per unit, sorry, but it's expecting a higher sales volume to be with gamma. So if we have a look at the pictures, so we have a look at the figures that we've got in there, I do apologise. We've got a sales volume of 50, where gamma is wanting to produce that sales volume of 70. Okay, so we're expecting then the higher sales volume, okay, in gamma. Okay, so you're pointing out there that you've actually recognised that although that beta is giving you that higher contribution, that, you know, gamma is actually wanting to sell more products. Okay. So the contribution for beta, you know, even though we're selling lesser products, we need to then do some form of calculations to see if the fixed cost, you know, how the fixed cost would be covered. Okay, the selling price has no effect on the difference in of contributions because both products are actually sold for the same. Okay, so if we have a think of what the contributions would be, okay, we could do some extra calculations. You're just going to explain in this point here, okay, explain what the total contributions would be based on their actual sales volume. So explain what the total cons would be. Based on sales volume. Okay, add your figures into there. So you've got, let's have a quick look, you've got your £1.50. So if you say to gamma, you've got your £1.50, multiply that by your 70,000 units. That's going to give you a contribution there. So 70,000 units, multiply that by 150 of £105,000. Okay, whereas beta, okay, if we're using £5.20 contribution and we're doing 50,000 units, okay, at 50,000 units, we can see that the total contribution there is £260,000. So by making beta with that higher contribution, still based on the volume, obviously we're getting near enough double the amount of contribution, okay, which is quite understandable given the fact that, you know, our variable costs were a lot higher in terms of the gamma product. Okay, so that's how far you need to go in terms of answering that question. The next part then would be implications of the difference in breaking even points between the two products. Okay, so if we have a quick look at the fixed cost, first of all, between the two, okay. So just making some notes at the side here, okay. So we've got gamma, okay. Gamma has a fixed cost of 93,000, okay, which is a lot lower. So these are the things that you need to explain, which is a lot lower than beta. You're just stating what you can actually see in the results, which is lower than beta, which has a fixed cost of 254,800. Okay. Which means, obviously, despite them having the lower of the fixed cost, it does have a lower contribution per unit. Okay. So just state that it has a lower contribution per unit. Okay, which means that it will have a higher break-even point than beta. Okay. Higher break-even point than beta. Okay. Oh, there we go. Okay. And if we think of that, look at the results that we've just calculated, up here. Okay, so we've got the fixed overheads of 93,000. We're dividing that over a low contribution per unit. It's going to give us a high number. Where, okay, yes, the 250,000 is a lot higher, but you are dividing it over the 520. So what we'll do is we'll take the break-even units and we're just going to clearly state that gamma has to have that higher level of break-even for them, obviously, to make sure they're covering the fixed costs there. Okay, so you can state in the question if you want that, gamma does need to produce 69,000 units to break even compared to beta, where they only have to produce 49. So you're just basically taking taking the information that you've calculated. And yes, it does take longer to start making profits because you've got to make more units. Okay, so you're just comparing the gamma's break-even units and stating that within the question. So gamma is 62,000, whereas beta there is 49,000, and you can add that note which the students just put on there. Gamma, it will take longer to start making profit because you've got to make those more units. Okay, so overall, comparing the difference, it's saying that gamma, okay, would need to produce, need to produce further 13,000 units, okay, more than beta to cover its fixed costs. Okay, so just a couple little pointers there, okay, for that one. Then it says which product has the better margin of safety and why. So again, you're just stating what you've calculated. Okay, gamma has a higher margin of safety at 11%. And again, like I say, I am abbreviating it down for writing, but I'll send you in full sentences afterwards. So gamma has a higher margin of safety of 11% than beta, okay, which is at 2%. So you're just stating your calculations. Okay, we need to state why. Okay, so firstly, gamma has a much higher sales volume than beta. Okay, so gamma has a more higher sales volumes than beta. And then if you want to, again, stipulate the figures, okay, you don't necessarily need to already because you've already done it up in an earlier task, okay? But you can say firstly, gamma has the most higher sales volume than betas. So although gamma's break-even point is much higher in terms of the units, this is proportionally a lower level of total of the sales volume. It's only, if we think of beta, the volume only needed to fall by 1,000 units before it's break-even and faces prospect of losses. Yeah, there's a big cushion there. I love these words coming through on the chat panel. Okay, there's a big cushion better for gamma for them to start making a profit, where there's only a 2% leeway for them to actually make a profit. Okay, so state that, you know, in the written tasks there. So there's a much greater, if you want to use a big cushion word, feel free to use a big cushion word, okay? But there's, you know, there's a much greater gap for an organisation to start earning profit, okay? Because in the lower levels of production, you have produced X amount of units before you start then to need to make a profit. Okay, so that's how we would go in and explain that margin of safety. The next point then is about comment on the results from a risk perspective and suggest any potential ways of reducing the risk. Okay, so looking at it from the outside in, knowing that there is a bigger cushion, I'm loving the word cushion, I'm going to use that. Okay, knowing that there's a bigger cushion. Okay, just scroll up a little bit there. Gamma is the safer option, you know, from a risk perspective. Okay, so just adding these notes on here from a risk, okay, perspective. Gamma is the safer option. Okay, so we'd first of all stipulate this. There is more risk with beta because there's only that 2%, isn't there? So what we're trying to say is if our sales volume, okay, so if our sales volume, if that falls over, okay, 11%, we will hit a problem. Okay, we will hit a problem. That's when we're not going to cover our fixed costs. Okay, so if the sales volume for Gamma falls over 11%, we will have a problem. Whereas, you know, we will probably likely have a problem more with Beta because the 2% is very, very small. Okay, so there is more risk with Beta. So we need to think of ways of reducing the risk. Okay, so to reduce risks within a business, the things that we might look at from an organisation point of view is cutting back on costs. Okay, main thing is cutting back on costs. Make things as cheap as possible because then we were able to cover it. Yes, we can encourage sales price, okay, but what we need to think of if we're increasing selling price, okay, is that going to have an impact on the sales volume? Okay, so, you know, you've got to think what is better for the business. Okay, if increasing the selling price is not going to attract the customer, then, you know, then we might then see a fall in our sales volume. And if you are Beta and you've only got that 2% leeway, it's not, you know, it's very, very risky to increase the sales price if you are the organisation of Beta. Okay, so the idea there, no, it's fine, it's a good question. If, you know, I know, David, you just scrap that product altogether. You might want to scrap it altogether. The company might decide not to do it, or they might just think of other ways by reducing the risk. And as I've said, cutting back on costs, thinking about reducing fixed costs, you know, looking at reducing variable costs. Can we buy cheaper material? You know, do we have enough staff? Or, you know, do we have too many staff? Now, somebody's put in the chat panel about redundancies. Okay. Yes, we can outsource them, but outsourcing things might come a little bit more expensive. And one of the learners just said there into the chat panel, when you outsource things come out of, you know, things get out of our the control. You know, we don't have control about that product then if we're outsourcing it. Okay, but yeah, quite rightly, investigate the cost drivers. What's making this product expensive as it is? Okay, so a question's come through there saying, would increasing sales volume help improve margin of safety? Yes, it would. Okay, but you can only increase sales volume by attracting the customer. You can increase production volume, but how do you know that the sales volume is going to be what it is? You've got a budget for it. This is why you look at trends, etc., and things like that. But yeah, we could look at increasing sales volume. We could look at increasing sales price. But in the first instance, when you reduce risks from an organisation, I would always look at what you can do internally first, because the sales, the volume, the prices, all comes from what customers, what they actually want. So if you're going to set yourself a really, really high sales volume figure, okay, and you're changing the sales prices, that might not actually work. Okay. Yes, buying things on bulk discounts, suppliers discounts. Get your buying teams to work their magic to get suppliers that can keep things down at a cost. So you've got some fantastic ideas coming here in terms of reduce. Put all these ideas down in your answers. Show the examiner that you know about cutting costs, what type of cost you can actually cut. The more info you can put in these questions, the better it is going to be for your results. Okay. So once you've said about gamma, or being obviously a safer option, one of the learners in the comment there said, let's scrap beta altogether. We probably wouldn't do that in the first instance, okay? What we would do is, in this question, yes, you would state that beta is the riskier option. Okay, it is the riskier option. Okay, but instead of actually looking at those costs and stuff, what you would do is you would just stipulate in this answer that you would need to investigate this a little bit further. Okay, so you would need more investigation. Investigation. There you go. You need to invest it a little bit more. Okay, let's have a would it be that if we did increase the selling price for that product, because we do have high fixed costs, okay, we want to try and get that contribution down, okay, because obviously it makes it a little bit better when we do have a little bit, of a lower contribution, okay, knowing that when we sell something, we're going to make sure it's covered, okay. So just make sure that anything that is riskier, you're stating that it needs to be investigated. Okay, so state why, state why the other option is riskier on that one. Okay, so it's not too bad, this question, because you do have all the information given to you. You've done some calculations. All you're doing is you're just comparing one against the other. If you want to, you can go through it line by line. When you start talking about sales volumes, compare the difference. There's 20,000 sales volume difference, state the figures. There's the selling price, which is identical, but they've both got different variable costs, which has an impact on the contribution per unit. You've just calculated that down here, and that's the part that would go into that first part of the task. So like I said, the questions are there. You just need to be making sure that you understand the results and that you can compare the difference. And as we said, give a logical explanation as to why this might be happening. Okay. So that's question 7. Okay, so what we're now going to do is we're going to go on to the final task of your exam, which is task 28. And this is all about decision making. So it's around about 15 marks, around about 23 minutes to complete this task. Okay. So as a management accountant, one of your main roles there is to help the management to make decisions, okay, on how the business is running, okay. So we'll be looking at, in this exam tends to be, this task are all about marginal costing, but just be careful in case they're bringing absorption costing, okay. So you're going to be using the marginal costing principles for this one, okay. You've got to still do some calculations, so we're still going to be looking at doing some contributions, and that will then help us to state some help with those decisions. So there are a number of decision tools that you can use, and again, just repeating information that we've seen from previous tasks, knowing how to do your break-even analysis, knowing how to do your limiting factor analysis, and the use of markup and margins, which is all to do with your profits. Okay, now just to give you, although we've got the answers here, what markup is, but the way I've got learners to remember this is, if I sell you a piece of paper, I've sold you, okay, a piece of paper, A4 paper, as a full sheet of paper. So that full sheet of paper is 100%. So I'm selling you 100%. Now, if you think of a piece of paper when it's lined, okay, it tends to have a margin in a piece of paper. So when we're thinking about margin, your selling price is equivalent to the 100%. Okay, so your cost of sales, if you was to going to make a profit margin of 20%, your cost of sales is equivalent to 80%. Yeah, so then, like I say, your margin there is just simply the 20. So that's how I deliver. And I know there's one learner on here who I taught this to last year or earlier this year or last year, and they did actually remember me saying this in their exam as well. So just try and remember, when you need to know the difference between margin and markup, always think of, I've sold you 100% a piece of paper. In terms of markup, I want to go up. Okay, so if I'm thinking of my cost of sales first, my selling price at the top, my cost of sales will be 100 and my price will be mark it up by 30%. My selling price, therefore, is going to be 100, equivalent to 130%. So it's just another quick way of looking about your markups. Okay, got to think about life cycle costing as well and target costing. Okay, so they will come into it. Taking into consideration as well activity-based and discounted cash flow. So we're going to bring everything together, kind of what you've learned in the chapter into the final question in terms of the key calculations that you need. Okay, so task 8, let's have a quick overview of what we need to do. So it says a business makes 2 products, Meg and Mog, sorry. The following information is available. So we've got each product's there. We've got the selling price. We've got the variable cost. So I'm just going to, we've got the variable cost there and we've got the fixed cost. So they're set up into 2 sections. So you've got your total there and your total fixed cost. So just to make them stand out a little bit more. It's told us what the profit per unit is. And at the bottom here is the monthly demand for the units. Okay, it states at the bottom that material will be in short supply in the coming month and only 750 kilograms of material will be available from an existing supplier. Now, what we've got to do is, first of all, work out what the contribution per unit is and the contribution per limiting factor. Now, it's already been established that the limiting factor is material in this case. So what is the contribution per kilogram? Then we need to then decide what the optimal production order should be. Should we make Mog first? Should we make Meg first? Which way around should we make them? Okay. And then from that, we will then be able to decide how many units we're going to produce of each of them and then what the total contribution is going to be. Okay. So I kind of do a bit of a table before I go and put this information into my exam because then it's kind of free flowing. Okay, so if I just come over to the side here, I'm just going to, first of all, set my columns up. So let's have a look at the data for Meg and then let's have a look at the data for Mog. Okay, the first part of the question in question A was to work out the contribution per unit. Okay, which we've already established is the selling price minus the variable cost. So you've got your £600, just getting the data from the table, £600 minus your total variable cost here. Okay, and again, 650 minus 450. So if you want to write it out at the side, you can do, or you can do basic maths at the side of your table. It's entirely up to you, but just showing you it in full workings. So 600 minus 450 gives you 150 contribution per unit. And for Mog, it's 650 minus 450, which gives you £200 contribution per unit. Okay. We then need to work out the contribution per kilogram. Okay, so what we need to establish is we need to actually establish how many kilograms is used in each product. Now, this part of the question here tells us it's £50 per kilogram. So if we're spending £150 on material, that means that Meg must be using 3 kilograms of material and Mog must be using 5 kilograms of material. Okay, so to work out the contribution per limiting factor, okay, we just simply take the contribution that we've calculated and we divide it by the number of kilograms required for each of the units. So you've got 3 kilograms for Meg, you've got 5 kilograms for Mog. Okay, so when you work out the calculations there, you've got £50 per kilogram as the contribution, and you've got £40 per kilogram as the contribution. Okay, so I'm just going to put those figures into the table that we've just calculated. So all these that are, oh, not that one, just highlighted that incorrectly, 3 kilograms. Okay, so all the figures there are the figures that we're going to use. So going into our table here, you've got £150, £200, £50 and £40. Okay, so the next question then, it says the optimal production order for the product for Meg and Mog is what? Now, what we want to do is we want to make the one which gives us the highest contribution per limiting factor. Although we can clearly see that Mog gives us the highest contribution per unit, the fact that we have got scarce material and we don't have enough material for full production, that's why we need to break it down and into contribution per unit, per limiting factor. Okay, and then we will then decide which order we need to make the product in. So because of this one, we're going to make Meg first and then we'll make Mog. So in this exam, it'll be a drop-down box and I either say Meg then Mog or Mog then Meg. These words are like tongue twisters. So we're going to do Meg then Mog. Oh. Okay, so as you can see, it's that option there that we are selecting. Okay, so what we need to do then is we need to complete the table to show the optimal production mix. So going back to my workings here, okay, knowing that I'm going to make Meg, okay, going to question C, let's have a look at how much we can do. Okay, so if we are making the 100 units, well, let's first of all have a look at the volume for each of the products. So you've got 100 units for Meg, okay, and you've got 120 units for Mog. Okay, so that's what we're going to look at first of all. We then have a look at the kilograms that's needed. Okay, so the kilograms per unit. So we've already said it's 3 kilograms and it's 5 kilograms. So in total, to make full production of Meg, we're going to need 300 kilograms of material. And to do the full production of Mog, we're going to need 600 kilograms of material. Now, we don't have enough, or do we? Because in the question, we only have 750 kilograms of material. Okay, so what we're going to do is, because we've already established we're going to make Mog first, we will make the full 100 units of Meg. Okay, so we can stick 100 units in this box here. We'll start making Meg first. Okay, we're then left with 450 units, because if we take away obviously the 350 kilograms of units used, that's going to let us make the 100 units that's needed. Okay, having 750 kilograms of material available and using 300, that's where we get the 450 kilograms. Okay, so because we can only make units which use 450 kilograms, we need to work out how many units we can actually make. So well done those that are putting that into the chat panel. So if you've got 450 kilograms of material left and each unit takes 5 kilograms to produce, you can only make 90 units of MOG. So all you do is you take your remaining material that you've got left, divide it by the quantity of material used to make one unit, then that will give you the 90 units. Okay, so going back to our table over here, we're going to make 100 of MEG and we're going to make 90 of MOG. Okay, then all we simply do then for the last part, it's saying complete the table below for the total contribution for each product. Now, this is where you've got to be really careful, okay, because the word is total contribution. Now, we've got the numbers, we've got the units here that we need to produce. Now, from the table at the top, we've got 2 lines of contribution. We've got 1 per unit and we've got 1 for material. Now, because we're interested in the total contribution, we need to be making sure that we're using the figures which relate to the units. Okay, so for MEG, quite rightly, you've got 100 units, which has a contribution per unit of £150. Okay, and that will give us the answer of 15,000. And then for MOG, you've got 90 units, which has a contribution per unit of 200, which gives us a total contribution of £18,000. Okay, so that's how you'd work out it based on limiting factors and the contribution when you've got scarce resources. Okay. So to finish this question off then, there's a little bit more writing that's actually involved, okay, in task 8, okay. It brings up a different scenario, well, it brings up a little bit of a scenario, some extra scenarios based around what we've just seen. So the business has been approached by another material supplier who can supply up to 200 kilograms of material at the cost of £95 per kilogram. Okay, this is a premium of £45 above our normal cost, because if you go to our scenario, it tells you that we spend £50 per kilogram. Okay, so if we can buy more, we're actually spending an additional £45 per kilogram. So we need to decide whether we should or not invest in that additional product. So what we're going to do is we're going to have a look at the contribution per limiting factor. And because we need to make 120 units of MOG, let's have a look at the contribution for MOG. And the contribution is only £40. Okay. So what we need to establish then with this one then is, because the contribution, so I'm just going to make some notes here just so it's easy for you to understand. So as the contribution per kilogram is, per kg is £40, okay, and the premium is 45, okay, the premium actually exceeds the contribution, so we're going to make a loss, okay, so the premium exceeds the contribution per kilogram, yeah, therefore we will make a loss. So in this case, we should not purchase that additional material. So well done for those who have popped that into the The answer, okay. So that's just kind of, then I'll give you the answer for this one. It's saying reason why. So, you know, just looking at the options that you've got available there, it's that first option, isn't it? The additional cost per kilogram is less. Oh, I've highlighted the wrong one. I do apologise. That's the wrong one that I've just highlighted. We're looking for the additional cost per kilogram is greater than the cost per unit. It's that one. I do apologise. I highlighted the wrong one there for you. Okay, so yes, we're going to make a loss. So we're not going to actually go ahead with that additional purchase. Okay. And then with this question, okay, it's all about your own understanding. Okay, so you need to, with this final question, is asking you to explain what target costing is. So in the exam, you just need to tell the examiner what you understand about target costing. Okay, so I'm just going to bring this up here. Okay, just so you get a little bit of an idea of the type of things that we're looking for. So it says here, explain what target costing is and explain the advantages of using a target costing approach. So first of all, as you can see, we've got target costing. It's an approach to determine a product's life cycle cost, which should be sufficient to develop specified functionalities and qualities while ensuring its desired profit. It involves setting a target cost by subtracting any desired profit from a competitive market price. Okay, so like I said, with this one, it's just you explaining that you're aware of what target costing is. Okay, so it's how we come up with the price of a product. It's what we're aiming to actually cost something. Okay, and we look at that by looking at the life cycle of a product, whereabouts is it going to be, determine what profits that we might achieve within that, and where that product actually sits within the market. Okay, so whether it's a growing market, you know, what percentage is it, where does it sit, the shares, is it high in the market, is there a high growth in it, and you'll do that based on that life cycle. You're then going to have a look at, like, say, the advantages. So what's the advantages there of target costing? It shows management commitment to processes to gain competitive advantages. So if we are doing target costing, we're comparing them against other organisations. If we can get things at a lower target cost, still achieving the same profit margin, we might be able to then reduce costs, selling prices, sorry. The product is created from the expectation of the customer, and therefore the cost is also based on similar lines. So obviously we'll be looking there as to what the customer wants, what they want to spend. All forms part of market research, in that, you know, when they're doing the life cycle in terms of the development and research stage, what is the customer after? Okay, the approach then is to design and manufacture products. The approach to designing and manufacturing products become market driven. So again, it's looking at market research. What do our customers actually want? What can we get things for, keeping those costs down? And then what we've got there is a couple of disadvantages. So it says a lengthened development cycle, okay, can cause delay. So if you're making a product and you are constantly trying to keep the costs down, you're doing a bit of market research, thinking about what things cost, where they're going to be, it is going to delay when that product is going to get launched into the market. So in the earlier stages of the product life cycle, that's when no money is coming in. So the profit is dipping within the organisation. So the longer it stays in that development stage of its life, the longer it's going to take for you to make profit. You're going to continue to make losses. Okay. Yeah, and like I said, there's a couple of disadvantages there. So what I'm going to do is I'm going to send this through to you anyway, so you can have a look at the type of things that the examiner is looking for. Okay, and it's with this one, it's all about your own understanding of what it actually means. Now, unless you've got a photographic memory, you can have a look at, take a snapshot of this in your memory and then take it in. It's all about you reading and actually learning what they are and what the disadvantages and advantages are of target costing. Okay, but in terms of the calculation side of things, I think they are quite simple, what we've covered over the last couple of weeks. The information's there. It's just about looking in those right areas. In each task, you generally have a table, okay? You might have to do some side calculations. If you've got to explain them, explain what you've been given and what you've calculated, okay? Give logical reasons as to why things might have happened within that business as well, okay? So thank you ever so much for logging in this evening.